Hello, welcome to the first video of Exam 3 material, and we're getting into the third section, which is the long-term decision making. The last section, the middle section, Exam 2 stuff, was short-term decision making, and the previous stuff was manufacturing, cost of goods sold. So here we're into the last section. Once we have Exam 3, there is one little small segment that we cover, which is time value of money and net present value. And it's just one chapter, and then we go into the final. So this is the last set of big material, and then exam 3, then one chapter, and then the final. Okay, so for today we're going over the first video of chapter 9. So these three chapters are actually not quite as intense as like chapter 7 and whatnot. So we're probably just going to be doing 2 videos per. Now you'll notice that I have questions 1 through 8. It seems like a lot, but you'll see in just a moment that it's actually just variations on a theme. So what we're going to be doing is budgetary work. So like I said, this is all sort of long-term decision making. And before we get into actually looking at the budgets, we should kind of know the structure of the budgets. So where do budgets start? Well, budgets always start with, and let's see if I can draw this out here. Always starts with your sales budget. So your sales department comes up with how many units we plan on selling, and then that trickles down and informs a lot of different things. So I'm going to do a figure that's similar to the one in the PowerPoints, but you'll see here that it's just a little bit different. Actually, I think it's a little bit more informative. From the sales budget, that'll tell us how much we need to produce, right? So we have a production budget. And from production, well, this is partly how it ties into what we've learned before. Production, you need 3 things. You need direct labor, you need direct materials, and you need the manufacturing overhead. So all 3 of these things should seem familiar. Now, if you remember, these were all the manufacturing items, right? And we did have one other thing, which is a sales and admin. And in this textbook, they actually call it the operating expenses. So these are the non-manufacturing items. And I put this on the same line because, well, you'll see in the next video. But essentially, next to the production budget, we're going to have, off to this side, we're going to have a cash budget. But we will integrate that next time. So I'm putting these 4 on the same line for a specific reason. Well, these 3 come together as your cost of goods budget. Now, we don't actually cover cost of goods in this textbook. It does in some textbook. Before accounting students, just realize that you individually figure out these 3 different budgets, the labor, the materials, and the overhead budget, and then those come together as your cost of goods. And from there, these get integrated into your budget, your income statement budget. Income statement budget. Now, you notice that I've left this without a feeder. In other words, what informs this? So the production numbers inform these 3 items, but actually sales informs this one. So let's just keep that in mind. That sales informs production. Production is then the target for these 3, and then figures into COGS, and then operating expenses is based off of sales. So what we're going to do is, except for this, we're not going to do a COGS budget, but we will do a sales budget, a production budget, these three individual production budgets, the operating expense budget, and an income statement budget. And that's why we have all of these different questions, because each of these questions that we're doing, 2 through 8, is one of these budgets. And I guess I should point out that there's kind of an easy one where it's just a multiplication type budget. There is I'd say a medium one where you have a fixed portion and you have a variable portion. And then I'm going to say a little harder, there's going to be some of these budgets that deal with inventory. And when you have inventory, it makes it a little bit more complicated. So just FYI, the production budget and the direct materials budget, these two have to deal with inventory. And as we go through, you'll see what I mean by there's basically kind of three styles of budgetary calculations. Okay, well, let's go to the first one here. So budget information, and here all they're asking for is a sales budget. And when we say sales budget, we actually want to know what's the revenue. And as you can imagine, when we get to the cash portion of the budget, this is where our cash incoming is going to be. And then all of these other things, so sales represents cash incoming, the labor, the materials, the overhead, and the operating expenses, that's all cash outgoing. So that's why I've kind of put these all on the same line, because these represent cash out, sales represents cash in. So let's figure out, now, just for the most part, the questions might require 3 months, it might require 3 months and a quarterly summary, or this, that, and the other. So I might just do a couple. I might just do 1 or 2, because essentially once I've demonstrated it, it's the same for each one. Now on the inventory ones, I'm going to do probably multiple months just because it's a little trickier. But here, we've got 2 products, product A and product B. All we're doing is trying to figure out how much we're selling of product A, and it says product A, the forecast is 220, and product B, the forecast is 190. The price is going to be 60, and the price for the second one is going to be 135. And when you multiply those out, this comes to 13,200. And this one, I'm cheating a little because I've already figured it out, 25,650. So obviously, you have 2 subtotals here, so you add those 2 together, and 38,850. So this is the sales revenue budget, right? So the sales budget as far as items, well, those are just the forecast numbers. So these would be how many items we're planning on selling. This represents the amount of money that we plan to bring in. So just another thing about this diagram here is be aware what is the input item. In other words, sales determines how much you produce. But you notice sales is not directly linked to labor, materials, or manufacturing overhead. It's production. So don't use the sales target for direct labor, direct materials, and manufacturing overhead. Use the production target. You figure out production from sales, and then that's a new target, and we'll see why in just a moment. And the point is, don't mix up. Use the right target so for the right budget, and it's based upon this graph here, this chart. So number 3, here we're going to be figuring out I think we're going to be going into the production budget here. And as I mentioned, this is one of the ones that requires an inventory calculation. So if you remember our inventory equation that we learned previously, it's that it is beginning inventory plus, and you can have lots of different words. You can have purchases, you can have this, that, but it's basically you have a beginning inventory, you have what comes in, so incoming, what comes into the inventory has to equal what is still in the inventory at the end of the month, ending inventory, plus whatever left. And if you remember, we use kind of a simple Ferrari situation, right? So if I said I started off, I had 4 Ferraris on my lot. I purchased 3 more, so I had a total of 7 I could sell. And I go out there and I count, and there's 5 Ferraris left. Well, by default, that means I must have, well, hopefully they're not stolen, but by default that means 2. So this inventory equation is an equation, but it's also kind of a truism. So if you notice down here, we're actually trying to figure out what are the units to produce, right? Well, the units produce, that's the incoming. Production is things you add to inventory. So we're actually trying to figure out for this item here. So if we rearrange this equation, it's going to be incoming or production, I'll put production here, equals, and we're going to just kind of switch this out according to how it's laid out here. It's going to be the outgoing, things that we took out of inventory, plus ending inventory, all I did was switch the order of these two, minus moved the beginning inventory over. And if you notice, that is exactly the layout of this chart. Unit sales plus ending inventory is the total needed, less beginning inventory is the units to produce. So, and sales is the outgoing piece. So what we're going to do is we're going to take the sales budget and we're going to plug this in. Now you notice we have a July, and I'll show you what's interesting about that here in just a minute. So 1170, June is 1360, and I'm not going to plug it in here, but I'll tell you why we need it. Well, I guess I can just put 1250 over here. Now it says on March 31st, 100 units were in inventory. Okay, why do we need to know that? Well, we'll see in just a minute. Now this is the thing that's, not only do you need to kind of understand that this is, the budget is based off of this inventory equation, but there is an inventory policy. And the reason why we have this is, even though budgets and financial statements are done month by month or quarter by quarter, that doesn't mean that exactly matches how production works. Production is a continuous flow. In other words, for this April, we don't make exactly 1,000 units and sell exactly 1,000 units, right? Because that would leave you with 0 units at the end of the month, and if you forecasted incorrectly. So what you're doing is you're continuously manufacturing, and you'll have a little bit on hand, and then you'll sell a little bit, and you'll make a little bit more, and you'll sell a little bit. So the actual flow is different from what the budget looks like. So what this is saying is that we're not going to sell down to where we have nothing in inventory. We want inventory at the end of the month to be 10% of the following month's budgeted sale. So we always want a little bit of inventory on hand, a little bit of cushion, so that we don't run out. Because the worst thing that can happen is you have a customer and you say, oh, I'm out of inventory. That's a lost customer. So this item here, this inventory policy just represents the reality of the situation, that you don't make everything and then sell everything and then start again and make everything and sell everything. You're always making and selling in small amounts. And so this 10% of the following month's budget is kind of representative of that. But what does that mean for this? Well, it says, okay, at April, we want to, well, if we plan on selling 1,000, we want to at least make 1,000. But remember, we're going to have a little bit of fluctuating inventory. So what does it say? We want to have, it said 10% of the following month's sales. So we look at the following month and we say, well, we want 10% of that. Well, we want 117. Well, similarly here, at the end of May, we want to have 10% of the following month, which is 136. And that's why, even if we're not calculating July, even if you're not asked to calculate July, in order to calculate June, you kind of need to know what's July's target so that you can figure out what's the ending inventory. Now here, they've kind of made it easy for you, where they said that the end of March is 100 units. Well, the ending inventory for 1 month, well, guess what? That's the beginning inventory of the next month. So if I said the end of March is 100 units, well, that must mean the beginning of April is 100 units. Now remember, if we had a fictitious March here, we'd also be saying the ending inventory for March is 100. So it's, even if they didn't tell us that, we could have figured it out. But they did tell us it. So the ending inventory of March is 100, and therefore the beginning inventory of the following month is 100. Well, we can do that. We can do that same thing. You notice that the ending inventory of 1 month becomes the beginning inventory of the next month. So we can put this here as 117, and this is 136. So really what you're seeing is you're going to make as many sales, you're going to make as many items as you're going to sell, plus or minus some inventory adjustment, right? So here you're saying your total needed is 1170 or 1117, sorry. And then you plan on having an additional less the beginning inventory. In other words, you have to produce this many to cover sales and your ending inventory, but you're starting off with 100. So you only need to produce this many. And you would do that with the same thing with here. So this would end up being 1306. But you ended up with, you're planning on having an inventory of this much, which is your beginning inventory. Ending inventory of the prior month. So in other words, you plan on making 1170 plus an extra 136 to cover next month. And then, but you already have some on hand, so you don't need to make all of that. And so this is 1189. And so for this one, it would be 1485. And, oops, I said 135. This should be 136. And so that would give you 1349. So I kind of recommend you go back and play this again, because there's two budgets that kind of do this looking at next month. It's this one and it's the materials, but well, it's in fact it's the two items on the two budgets on the list that actually focus on inventory, or that have a beginning and ending inventory. So this is one of the two that kind of go according to this pattern. Okay, well, let's move on down. So now we're going to have some information about the raw materials. Okay, so we're going to go directly into materials, which is very similar to the previous one. In other words, there's a beginning and ending inventory, and so we're still going to have this equation of the production is going to equal, well, we're not going to be selling it. So this is the previous one. Production equals sales plus ending inventory minus beginning inventory, right? What changes is we're not producing it. What we're doing is we're buying this. And this is the raw materials, buying raw materials. And the sales is what we're doing, is what we're producing. So the way we go about calculating it is the same. There's only one little extra, I guess, wrinkle to this. And the fact is that you have to translate the unit, the production budget. So this is the production. This is how many we are producing. You have to translate that into a raw material budget. And then you can do all of the fancy stuff. So let's go ahead and take a look at how we're going to do that. Like I say, it's the same process, just one extra step. So units to be produced. So we've got 1540, we've got 1820, 1660, and just like last time, in order to do this magic, you need to have 1460. You need to figure out some information about this one as well. Well, how many materials per unit? Well, it's flour, and it's a half a pound. It's a half a pound per loaf of bread. So even though we're planning on producing 1,540 loaves of bread, we're going to multiply that by 0.5 to get the amount of flour that we need. Okay, so we do this, and this becomes 770. This becomes 910, and this becomes 830. And well, I guess this becomes 730. I might not do it all the way out to this month, but let's just take a look. So if you notice, this is going to be the same thing. It's going to be the production plus ending inventory minus beginning inventory equals the thing that we're looking for. And here's the quantity to purchase. So what is our ending inventory? Well, we could figure it out. Well, let's take a look. So our policy is 20% of next month's requirements. Ending inventory is for the end of June. So June was the ending inventory for June was 154. But we could see that, we could have calculated that. They didn't need to tell us that, because 20% of this is this number. So if I were to do this again, 20% of 910 is going to be 182. 20% of 830 is going to be 166. And well, I could figure this out, but I'm going to leave this one blank and let you kind of work it out, because once we do the first two, the process is understandable. So the total needed is 952, and this is 1076. So less beginning inventory. Well, the ending inventory of the prior month becomes the beginning inventory of this month. So in other words, what we had on hand at the end of June is what we have on hand at the beginning of July. So we take this number, and that becomes 182. And if we were to figure out this last column, this would be 166. So once we figure this through, so this is 798, and this one's 894. Now, this is pounds. This is the quantity to purchase. And that could be one question. It could be how many pounds. But a lot of times the question actually is, what's the total cost? Well, we have one more bit of information here. It's $2 per pound. So not only do sometimes the question we have, all the questions we have to translate the production into raw materials. So this is production and this is raw materials. We got to do this step first before we do our plus and minus inventory stuff. But at the end, if they're not asking for pounds, if they're asking for total dollars, we have to multiply this by $2 per pound. So the answer in this particular case would be 1596 and 1788. So those are the two hard ones. And like I say, go back through if you need to, and listen to it again. But it's the same process for each, just one extra step on the front end, changing production units into raw material units. Okay, so good news is that most of the rest of them are simpler. So let's go ahead and take a look at let's go back up for just a second. So you can see we're working through these different budgets, right? So we've worked through the sales, we've worked through these middle three. We've worked through sales, we've worked through production, and we worked through direct materials. So we still have the direct labor, the manufacturing overhead, we have direct labor, manufacturing overhead, and the operating expenses, and then we're going to combine that into the income. So this one is going to be the direct labor budget. Okay. So the direct labor budget, there's no inventory. You don't put labor on the shelf. You don't have to have an ending inventory or beginning inventory of labor. So it's really just a straight calculation. You're looking at production. You're saying, okay, January is 560 units, 630 units, and March is 860. I'm not going to do all three. I'll just do one of these. Well, what's the direct labor per unit? Well, it says each unit requires 6 hours of direct labor. Okay, well, that makes sense. So if I'm going to make 560 of these and requires 6 hours of labor for each, well, that means I have 3,360 total hours of labor. And if I want to figure out the cost, because it is a budget, it's $19 per hour. So we have these two bits of information here. So if I multiply that out, this would be, well, it's a big number, 6,840. And so you can see there's no interaction between the different months. It's just making sure you multiply things out. You see the numbers, you multiply them out, and it would be the same for each of these. So that's the labor budget. So you remember I said that there was a easy, medium, and hard. This is one of the easy ones. The two inventory, those are the hards. Now the third type, the medium one, is that there is a variable and a fixed. And ta-da! Here we go. We've got a variable and a fixed amount. So not that it's more difficult, it's just you do two items. You have to calculate two items and add them together. So once again, unlike inventory, there's no month-to-month interaction. So I'm just going to do one of these, but it'll be the same for each month. So direct labor hours. So this is going to be figuring out the manufacturing overhead. So once again, if you remember from our previous things, we figure out manufacturing overhead based upon some other number. Sometimes it could be production. Here, it's based upon the direct labor. So direct labor hours. So if we have these budgets So I'll just do the first one here, 490. So there's going to be a fixed rate, a fixed manufacturing overhead, which is just a one-time per month. Remember on our graph, this would be the fixed rate, and then there would be a variable rate, and so it'd be a mixed cost. So the rate here is $1.70. So I'd multiply those two out, and this comes to $833. And then I'd add in the fixed rate. So you calculate the variable part, you add in the fixed part, and the total is 4,633. So as you can see, there's no month-to-month interaction. It's just the same calculation same method of calculation each month. And in fact, the 3,800 stays the same all the way through, and the $1.70 stays the same month to month. And so really all you're doing is calculating a new variable part and then adding that to the fixed part. Okay, well, we're getting close. We have 2 more questions. Okay, so this is another one that is a variable and fixed part. So once again, I will just do 1 month because it's the same for each month. There's no interaction between the months. You don't have to worry about beginning or ending inventory. So here, as I mentioned, if you remember back, I said the direct labor, direct materials, and manufacturing overhead takes their number from the production budget, but the operating expense budget takes it from the sales budget. So just remember, they may give you, the production budget and the sales budget, and you have to remember which one it is. So the operating expense is based off of the sales. So here, and they've prompted it to you, sales units. So if we take 1,220 units sold, we're planning on selling that much in July. Well, we've got a variable expense part, $3 per unit. When we calculate that out, that would be, well, I see they times 3. So this is going to be 3,660. And now we could have just added these 3 together. We could have just kind of gone through and added these together, and that would be the total fix. But they've given them to you separately, and perhaps there's a question that there could be a question where it changes over time. But essentially what we're going to do is we have these 3 items that should be stable: 5,700, 3,800, and 2,900. And when you add those 3 together, they come to 12,400. So when we take, this is 1220 times 3. We don't actually have a box here for this multiplication, which is a bit strange. I'm taking this actually from the question so that it looks similar. So you've got this subtotal of the variable, you've got this subtotal of the fixed, you add them together and you get 16,060. Okay, the final one. So a lot of times the questions would be, you'd go through and figure out each of these budgets, and then you'd take the information and put it all into an income statement. However, the question here's these mysterious scritch marks. How I see that they're doing it in the homework, at least, is that they're giving you a bunch of the numbers and you're just putting them, rather than pulling them from previous questions, they're giving you part of the information. So let's just go ahead and create this income statement. So sales, well, that's going to be the 1,500 times the sales price. So these are big items. These are expensive items. Some sort of maybe they're audio equipment, or there's some kind of high-priced item. So unfortunately, this makes the numbers kind of big. 348 million less the cost of goods sold. Well, we've got the average manufacturing cost is this. And normally, remember I said there's a cost of goods budget where you'd add in the direct labor, the direct materials, and the manufacturing, and you'd figure out a per unit cost. That's where this would come in. So you're still selling 1,500 units, but the cost of each unit is $1,420. And so 21,3 000. Or alternatively, you could take 2320 minus 1420 and multiply that by 1500, and that would still give you the same number for gross profit. Okay, now we've got a variable operating expenses. So this is 1500 times $1.40 per unit sold, and that comes out to 2100, 2100. Less the operating expenses fixed. Well, we've got fixed expenses of 7,600. Seems like quite a small amount for the amount of sales. I mean, that's pretty good. So we would have a subtotal here of operating expenses. So that would come out to 1,340, 300. And some books do this and some don't. But I actually like that the fact that they have the other expenses, which is interest expense and taxes. Taxes 40, and so we would say we would figure out this 40%, and I think it's going to be calculated off of this here. 40% of income before, well, let me see. Let me just double check. Okay, so they didn't subtotal it, but actually what they do is they subtract these numbers and they get 1,337,000, and then they take 40% of this. So not this, take 40% of this, and you would get 534,800, and you would take these numbers and subtract it out, and it'd be 802,200, and that would be your net income, or at least your budgeted net income. And of course, your tax rate may not be exactly 40%, but you would take some tax rate that you are planning on, or maybe a little bit higher. Okay, that is a little bit long, but all those operating budgets are best to do together. And the next video will be on the cash budgets and how they integrate. And we'll look at a lot of the same methods, but just dealing with the cash. So this is the product side, the production side, and the other budget is the cash side. Okay, thank you. And as always, if you have any questions, visit me on Zoom or email me.